Here's something that might shock you. While economists debate whether we're heading toward recession, Wall Street just delivered its most spectacular performance in months, with all three major indexes simultaneously crushing previous records. On Tuesday, September 9th, financial markets experienced what many are calling a Goldilocks moment. That perfect sweet spot where economic weakness becomes bullish news. The S&P 500 surged 0.27% to close at 6,512.61. The Nasdaq climbed 0.37% to reach 21,879.49. And the Dow Jones Industrial Average jumped 0.43% to finish at 45,711.34. Each of these represents fresh all-time highs, extending what has been an extraordinary year, fueled by artificial intelligence enthusiasm and anticipation of cheaper money. But here's where it gets controversial. Investors are essentially celebrating bad economic news. The catalyst for this seemingly paradoxical rally came from a significant government revision revealing that the U.S. economy created approximately 911,000 fewer jobs over the 12-month period ending in March than officials initially reported. For most people, fewer jobs would signal economic trouble. For Wall Street traders, however, this data serves as ammunition supporting their bet that the Federal Reserve will slash interest rates to stimulate growth. Think of it this way. When the economy shows signs of slowing down, the Federal Reserve typically responds by making borrowing cheaper through rate cuts. Lower interest rates make stocks more attractive compared to bonds and savings accounts, driving investors toward riskier assets like equities. Financial markets have already priced in expectations for a 25 basis point, 0.25% rate reduction at next week's Federal Reserve policy meeting, with futures trading indicating nearly a 10% probability of an even more aggressive 50 basis point cut, according to CME's FedWatch monitoring tool. Paul Nolte, a market strategist at Murphy Sylvester in Chicago, explained the situation clearly. This does nothing to dissuade the Fed from moving 25 basis points. We don't know, month by month, and won't for a few more months yet. But it points out that labor is weak. Recent employment reports for July and August have reinforced concerns about deteriorating labor market conditions. And this is the part most people miss. Individual stock movements told fascinating stories beyond the broader market euphoria. United Health emerged as a standout performer after announcing that enrollment projections for top-rated Medicare insurance plans align with company expectations. This seemingly mundane update actually carries significant financial implications. Higher-rated plans typically generate larger government reimbursements for health insurers, directly boosting profit margins. J.P. Morgan Chase shares climbed 1.7%. Following optimistic guidance from senior executives, who projected investment banking revenue growth in the low double digits for the third quarter, alongside markets revenue expansion in the high teens percentage range. Jed Ellerbrook, a portfolio manager at Argent Capital, interpreted this positively. That's all good news, signs of a good, thriving economy. MA is coming back after Trump's Liberation Day put a screeching halt to that, referring to comprehensive tariff policies announced in April. However, not every major corporation benefited from Tuesday's rally. Apple shares declined 1.5% after the technology giant unveiled new iPhone models that failed to generate investor excitement. Similarly, Broadcom dropped 2.6% following 5 consecutive sessions of gains, suggesting some profit-taking among shareholders of the world's second most valuable chipmaker. The artificial intelligence sector provided both winners and losers. Nebius absolutely exploded higher, soaring nearly 50% after securing a massive $17.4 billion infrastructure agreement with Microsoft. This deal represents one of the largest AI-focused partnerships announced this year. highlighting the continuing corporate investment in artificial intelligence capabilities. Competitor CoreWeave also benefited, jumping 7% on spillover enthusiasm. Meanwhile, media conglomerate stocks experienced turbulence following succession planning news. Class B shares of Fox Corp tumbled 6.7%, while News Corp declined 4.5% after Rupert Murdoch and his family members reached an agreement granting eldest son Lachlan Murdoch control over the media empire. A real-life succession drama that investors apparently found concerning rather than reassuring. Albemarle faced the day's most severe punishment, plummeting 11.5% due to evolving lithium market dynamics. Concerns about supply shortages have been easing as Chinese battery manufacturer CATL prepares to resume production at a significant lithium mining operation, potentially flooding the market with additional supply and pressuring prices. Looking at sector performance, 8 of the 11 SP 500 sector indexes advanced, with communication services leading the charge at 1.64% growth, followed by utilities gaining 0.71%. Year-to-date performance remains impressive, with the SP 500 up approximately 11% and the Nasdaq posting 13% gains. But here's what makes this situation truly controversial. Are investors being rational by celebrating economic weakness, or are they setting themselves up for disappointment? Trading volume remained relatively subdued at 15.6 billion shares, slightly below the 20-session average of 16.1 billion shares, suggesting that while prices moved higher, conviction levels weren't necessarily overwhelming. Within the SP 500, declining stocks actually outnumbered advancing ones by a 1.4 to 1 ratio, indicating that the headline index gains were driven by select large capitalization companies rather than broad-based enthusiasm. Market participants will focus intensely on upcoming economic data releases to gauge whether current optimism is justified. In after-hours trading, Oracle shares surged 12% following quarterly earnings results, suggesting that corporate fundamentals continue supporting equity valuations despite macroeconomic uncertainties. The fundamental question facing investors now is whether this rally represents a sustainable response to changing monetary policy expectations, or simply a temporary sugar rush based on wishful thinking. Historical precedent suggests that markets often struggle when economic weakness becomes severe enough to actually harm corporate earnings, regardless of Federal Reserve accommodation. What do you think? Are investors being smart by positioning for lower rates, or are they dangerously ignoring underlying economic deterioration? Is celebrating job losses and economic weakness a sustainable investment strategy? Or will this optimism eventually collide with harsh reality? Share your thoughts. This debate could define market direction for months ahead.